Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin with ApexInvesting.com. Today what we're going to do is we're going to go into bull and bear box spread strategy examples. We're going to talk about spread values, spread risk and reward, spread profit and loss, spread settlement, and we're going to end with multiple examples of how spreads work. First, let's go into the spread's value and how that's determined. If we were to look at the bull box spread example and we look at the top spread, which is the 1365 to 1335, I'm going to show you how to calculate the spread's value. It's really simple. What you do is you take 1365 minus 1335, and the difference is 30 points wide, 30.0. What you want to do is remove the decimal point, okay? So basically, instead of having to divide by 0.1, it's really simple. Just remove the decimal, and you'll get 300 ticks. Well, every tick on Nadex, on every single spread, is worth $1. So 300 ticks at a value of $1 each is a $300 spread value. So this spread has a value of $300. So now that we understand the spread value, let's look at the spread risk and then the spread reward. If we bought this spread, the 1335 to 1365 box spread, and we'd be doing a bull box spread strategy, and we bought the spread at 1337.6, then our maximum risk would be from 1337.6 down to 1335, which is the floor of the spread. All right, so right here we have a Nadex ticket. Okay, this is what you'll actually see in the Nadex platform. And we know the spread's value is $300, so now we're going to look at the risk and reward. Well, we're going to buy the spread, and we determine we're going to buy the spread at 1337.6, so that's the value that the spread is currently quoted at, which you can see right there in the ticket. And in the platform, if you just click right there on that price, it'll actually fill in the current price. So 1337.6. We're going to minus it from the spread floor. And again, on the ticket, you can see right here, the spread's floor is 1335. Well, the difference between these two is 2.6. So again, we just remove the decimal, and we have 26 ticks. Well, 26 ticks times $1 per tick is $26. And that actually is our maximum risk. And you can see the Nadex ticket actually calculates this for you automatically. So you don't have to do all this math. It's right there for you. But it's good to know where that risk comes from. So another great thing to think about right here is the margin. The capital required to place this trade is the same as the risk. That's how all the spreads work. It's defined risk. So the most money you have to put up to place the trade is $26. Now let's look at the reward potential on this spread. So the reward potential on the spread is going to be the difference from where we bought the spread up to the ceiling of the spread. Again, you'll see that there on the platform and in the ticket. And our ceiling strike is 1365. So the difference between 1365 and 1337.6 is how much money we can make on the spread. And as a review, the reason this is a bull box strategy is because we're buying the spread. And the reason we want to buy this box is because it's very close to where the market is currently trading. The floor, being 1335, is very close to 1337.6, so that lets us have a lower risk trade. So the way that we calculate the reward potential on the spread, again, a $300 spread value, is we look at the ceiling of the spread, okay, which is 1365, and again, we can see that right over here on the Nadex ticket, 1365, and you'll also see it in the market watch area. 1365 right there, and we look at the spread, the price where we bought the spread at. So we bought it at 1337.6, and if you click right here, it'll fill in the price. And when you do that, it'll actually automatically calculate the risk and reward for you. Well, if we take the ceiling and we minus it from the floor, that's the difference. That's the profit potential of the trade, and so therefore the difference is 27.4. Well, again, remove the decimal, and that gives you the ticks, 274 ticks. Each tick per spread is worth $1. Therefore, we have a $274 profit potential. And like I said, you can see that right there on the ticket. So looking at this trade right here, you actually have the potential of a $274 profit with a risk of only $26. So you got to have a 1 to 10 risk reward ratio, meaning you can make over $10 for every $1 at risk. Now, this is the key concept that helps you understand the true value in Nadex spreads. Not only can you have the limited risk and reward, and not only do you have the ability to not worry about margin calls, and there's so many other benefits, but you will never get a whipsaw trade. A whipsaw is when the market spikes against you in the direction that you're trading and knocks you out of the trade. It hits your stop loss, because if you're a good trader, let's say you're trading the S&P E-mini futures, and you have a stop loss, it spikes down, it hits your stop, and then it goes right back in the original direction you're trading to begin with. And, when that happens as a trader, where does that put you? You basically have to go in and you have to either place more money at risk to continue going in that direction. You have to place money at risk and possibly get whipsawed out again, going the opposite direction, because maybe you think now it's going down, or you decide to sit on your hands and watch the market make a bunch of money while you don't make anything because the market's flying up like you thought it was going to, or you don't use the stop loss and then you can get wiped out. So with Nadex spreads, you don't have to worry about that. All the products on Nadex, you have until expiration of the trade to be right. Therefore, you're never going to get whipsawed out of a trade. So for instance, let's say you bought the spread at 1337.6. So you bought the trade, and then you set a stop loss, let's say right here, okay? Market spikes down, and it could whip you out of a trade. No matter how far down it goes, you're still in the trade if you're in the Nadex spread. If you were just doing a future contract, you could easily get spiked out. And you're getting really nervous as it's dropping down. You don't get nervous. My risk on this trade is only $26. So, again, you don't have to worry about getting whipped out. So if the market goes down here, if it comes up before expiration, which in this case is 4:15 Eastern, 3:15 Central, then you still have the potential to make a profit. Now let's look at how a profitable trade would actually go. All right, so on this example right here, you came in, and as we said, you bought the spread at 1337.6. Now understand, you can close this spread at any time you want to before expiration. So you could have bought it here, and you could have closed it right here. Or you could have closed it up here. Or you could have closed it right here. You could have done whatever you wanted to. You could have closed it whenever you wanted to, or you could let it settle. And in this case, the spread settled at 1340.65. That's basically where the market was at when the spread expired. So in this case, we bought the spread at 1337.6 right here, and you can close the spread at any time before expiration. So you could have bought it here and closed it right here. You could have bought it and closed it up here. You could have bought it and closed it right here. You could have closed it whenever you wanted to, or you could let it go all the way to expiration and settle. So in this case, the spread settled at 1340.65. That means that's the price the market was at expiration. We'll go into settlement in a little more detail here in a second. And again, you had from 7 a.m. to 3:15 Central Time, or 8 a.m. to 4:15 Eastern Time when the spread expired. So when it expires, what's happening is you're going to actually get an email from Nadex immediately saying that your position has settled. And it'll actually tell you on the example that the contract US 500 1335 to 1365 4:15 expiration spread has settled at 1340.65, and your payout amount is $56.50. So how did they come up with that payout amount? Okay, well, we know that the spread settled at 1340.65. We know the floor, which is what you're going to use whenever you buy the spread there, the floor was 1335 right here. The difference of that is 5.65, so you can either divide by 1. So we convert that into ticks, and what we get is 56.5 ticks. The tick value is $1 per tick, so you have a payout amount of $56.50. So what does that mean for your actual profit? Okay, well, what did you put up at risk? And this is really important to understand, because sometimes when people see the payout amount, they think that they made $56. Well, remember, you had $26 at risk on the trade, right? So you put up 56, and they also gave you back the initial capital, the margin you put up, the $26. So your actual profit on this trade is $30, which, if you look at that, on a $26 risk, making just $30, and you have the potential to make something dollars, $274, the potential was huge. At the same time, even only making $30 on this trade, your return on investment was 115%. And one thing to note right here is whenever you're trading futures, it's hard to really calculate return on investment because you're putting up a margin, but that margin isn't your risk. It isn't your total cost, because you also have to have the money for the floating profit and loss that takes place. On this, your margin is your risk, that is your investment. So once you know your profit, you actually do know your true return on investment, whereas futures is more of a return on margin plus any floating P&L that had to take place during that. So now let's look at what happens if on this exact same example, you had a spread that lost, that did not make money. So in this example, we're going to look at the bottom spread, okay? So that's the spread that's 1335 to 1305, and we'll check that out and see how that goes. So on this trade right here, we're going to sell the 1305 to 1335, and we're going to sell it at the price of 1334. All right, so what that means is our maximum risk is going to be between 1334 and the ceiling of 1335. So the spread starts trading as early as 7 a.m. Central and goes as late as 3:15 Central, or 8 a.m. Eastern and 4:15 Eastern. The spread ceiling again is 1335, and the spread's floor is 1305. And we already talked about the spread width, so if you take 1335 minus 1305, you get 30.0, remove the decimal. You have 300 ticks. Every tick on every spread is worth $1, so therefore you have a $300 spread value. So if we want to look at the risk on this trade, since we're selling the spread, and you'll notice right here we're selling it, whereas the other one we were buying it, then you're going to take the spread ceiling 1335, which again you can see right here. You can also see it right here. Okay, and we're going to minus it from the price where we sold it, being 1334. And just like on the other one, if you click right here, click on the sell price, you'll see 1334. You can click that, and it'll fill the price in for you. The difference is 1.0. We remove the decimal. Our ticks, 10 ticks. Each tick per spread is $1. That gives us a maximum risk of $10 on this trade, which means the only money we have to put to place the trade, the margin capital required for this trade, is $10. And again, you don't have to do all this math. It's done for you automatically in the ticket. Right there, maximum loss potential $10. Your risk is always the amount of money you have to put up to place the trade. So now let's check out the profit potential on the trade. So if we sold the spread at 1334 and the floor of the spread, okay, is 1305, then our profit potential is going to be the difference between 1304, and if the market goes down, we can make money all the way down to 1305. So if I sold the spread at 1334 and the spread's floor is 1305, and again, that's right here, we got 1334, the price we sold the spread at. 1305 is the floor of the spread. It's also right here. Okay. The difference is 29.0. We take out the decimal. We got 290 ticks. $1. It's $290 profit potential. And again, that shows you right there in the ticket as well. That's your profit potential on the trade. So you're risking $10 to make a potential $290 profit. So before we were looking at, buying this spread up here, but now we're going to be selling this spread. Okay, it's a bear box spread strategy. So the market's going down, and you think it's going to keep going down. So you go ahead and you sell the spread. Now remember, you could have bought it back down here, but let's just say you held it all the way to expiration. Okay, so you hold it to expiration. You sold it at 1334, and then what happens is the market settles out at 1340.65. And then what happens is you get your settlement email, comes right out to you within, seconds, maybe a minute or two, but really fast. What happens is you're going to get a thing that says the expiration value, the settlement value is 1340.65, your payout amount is 0. So again, 1340.65, payout amount is $0. Okay? So the way that they figured that out is, remember, the spread expired above. So we had our box right there, and 1335 was our ceiling. Well, it expired up here, so it's outside the box. Okay, it's above it. And remember, we sold the spread. So what you do is you look at, well, what was the payout? 0. What was the risk? $10. So we had a loss on this trade of $10. With a profit potential of 290, could it have folded? And again, we could have closed it out before expiration if we chose to do so. In addition, you don't just have to sell one, and you don't just have to buy one. So you could have sold 5, or you could have bought 5 spreads. And that would, of course, just multiply the profit out, or the loss out. So now let's go into settlement of Nadex spreads and exactly how that works. On the settlement of a box spreads are cash settled. That means what happens is that payout email that you saw, you get that money put right back into your account right away, and it's cash. So you don't have to worry about, taking delivery or getting exercised on or any of the other stuff that you hear about with futures and options, okay? So with the future box spreads, the Nadex spreads, the payout amount is simply determined by the reference to the ceiling and the floor like we just looked at. So how do they come out with the settlement amount? Where do they come up with that number? What they do is they take the last 25 trades, okay, and they go in and they basically remove the 5 highest and the 5 lowest price trades. And then they average the remaining 15 and they round it off. So let's go ahead and look at an example of exactly, how that comes out. A couple important points that you want to know is, maximum risk was put up. So you're not going to see your balance decrease at the end of the trade, okay? It decreases the moment you put the trade on, because what they do is they take the capital allocation out because you put up maximum margin, maximum risk immediately the second you place the trade. Now, you may see a credit to your account balance within minutes of the settlement, the expiration, which is great because then you can take that money, if you do have money paid out to you, that you can use to make another trade. And it's important to understand, let's say that you had a $20 risk on the spread and the trade lost $10 and you saw a $10 credit to your account. That doesn't mean you made $10, right? Because you put up 20, you got 10 back, so you lost $10. If you put up $20 and the payout amount was $20, you didn't make anything, you broke even on the trade, okay? And if you put up a $20 risk and you made, let's say, $80 on the trade, you'd actually see a payout of $100. $20 of the risk plus the $80 profit. So you see a $100 credit go right back into your account. Another great thing is, let's say, like on that losing trade that we were looking at, if the spread goes, out of the money, so it has maximum loss there, then what happens is there are no exchange fees on an out of the money spread that settles. And so if you have a trade that's, already at maximum loss, there's no reason to close it because you can save yourself exchange fees. Exchange fees vary by volume from, 90 cents a contract to 25 cents a contract. For comparison, the CME charges $1.16 a side on the S&P E-mini futures contract for exchange, clearing, and NFA fee. Now, understand that, again, all contracts are settled based on the underlying market. And honestly, on spreads, you're not really going to be concerned about the settlement as much because, like 1 or 2 ticks difference. But on binaries, if you decide to trade those, and they're completely different than spreads, but if you decide to trade those, it can be huge because it can mean the difference between a win and a loss. So it is good to understand it and where that number comes from. Let's go ahead and check out an example of settlement. So right here we have the US 500, 1335 to 1365. And then we have the last 25 trades before expiration. And remember, they're going to take out the 5 highest trades and the 5 lowest trades. Again, these are on the futures, the underlying market, okay? And they get the data feed from routers. And then they're going to take the remaining 15 trades. So you add all those up, and then you get the average. You divide them by 15. That gives you 1340.650. Okay, what they're going to do is they're going to round it off to 1 decimal point past where the Nadex market quotes. So let's say the Nadex market, remember, it has a 0.1, 0.2, 0.3, 0.4 on the US 500. So they're going to bring it 1 decimal place past that. So they're going to actually round it off to 1340.65. And that's where you get the settlement price of 1340.65. So again, there we go, 1340.65. Settlement value on the contract, showing you what your payout amount would be on that trade. Okay, now I want to go through several examples with you on these trades on a couple different products. I want to show you an example on oil. I want to show you an example on pound dollar. I want to compare pound dollar spot to pound dollar on Nadex. So let's go ahead and start with oil. And we're going to go ahead and look at our box spread. And the box spread is going to be starting over here, and it's going to actually expire at 230. And the floor is going to be 75, and the ceiling is going to be 80. So on this example here, what we see is that we're going to go ahead and look at buying the spread at 75.25. Well, that's going to make our risk 25 ticks, which is a $25 risk on the spread. So let's see what happens on this trade. So the market goes down and really spikes against you, okay? So normally in oil, market moves that much against you, you're out of the trade, you're stopped out if you're trading oil futures. Okay, well, by the end of the trade, the market actually comes back up, and it settles out at 75.55. So on this particular instrument right here, on this trade, you would have made a $30 profit. And, I mean, that's on a $25 risk, so over 100% return on your investment. Well, let's look at it, and what happens if the market just flies up? Well, on this trade, it would have settled out at 80, because remember, you can make money all the way up to the ceiling. And so on this trade, you would have made $475 on a $25 risk trade. You only put up 25 bucks, market went all the way up to 80, you would have made $475 profit. Now, what happens if the market, sort of zigzags around? Remember, you can get in and out whenever you want to, but let's say you hold it till expiration. If you hold it till expiration, it expires at 77, then you made a $175 profit on the trade. But you didn't have to hold it to expiration. You could have got out right here. So let's say you got out at this point, you would have made $85 profit on a $25 risk. Or maybe when it spiked up, you got out at $78. You would have made a $275 profit on a $25 risk. Or maybe when it dropped back down, you got a little bit nervous, you didn't want your profit to go away, whatever reason you decided to get out, you would have made a $135 profit if you would have sold the spread out at $76.60. So the big thing I want you to see here is that you can get out of the trade before it expires, or you can let it go all the way to expiration and let it settle. So now let's compare the pound dollar spot to a pound dollar bear box spread strategy. Okay, so we're going to go short the pound dollar. So you're looking at your setup here, you pull up your charts, you throw, got a trend line going on. You look at that and you're like, all right, I think I'm ready to go short on this trend line here. And you look at the setup and everything. So you're looking, okay, I'm going to go short right about this price level. And you're looking up here and you're like, that's where the market spiked up last. I'm going to go ahead and I'm going to place my stop. This is if I'm going to do the pound dollar. And so you're going to place your stop right there, and then the market starts moving, okay? So you go ahead and you sell one full lot of 1.568 at 1.5685. You set your stop a little bit, like I said, above there, 1.5750. That gives you a risk of $650 and a margin of $3,138 if you're doing the pound dollar spot. And you go ahead and do it, and then it spikes against you, knocks you out of the trade. You just lost $650. And then, you know what? That's horrible. But what's even worse is when the market just flies down right after that, and you're like, what? I knew I was right, but you didn't have time to be right because you got stopped out of the trade. So now let's look at if you would have used a box, okay? Exact same trade. You're looking at everything. Your spread ceiling is 1.5700. Your floor is 1.5450. You have the potential to make 250 pips on just one contract. So you're all in on this trade. You're looking at it, and you go ahead and just sell the spread at 1.5665. That gives you a $35 maximum risk. And you go ahead and sell 10 of them. Okay, so now you have a $350 maximum risk on the trade. With that trade, your risk is $350 and your margin is $350. That's all you're placing out to place the trade. A lot less than we were looking at before. And so the market spikes up, but you know what? You're down, but you're not out. You have time to be right. Market comes back down, you were right, and then the market settles at 1.5589. You make 76 ticks on the trade. You do that on 10 spreads that you sold. You made a $760 profit on the trade. If we compare the two together, you were $650 on the spot. You only risked $350 on the Nadex pound dollar. You put a margin up of $3,000 on the spot trade. You only put a margin of $350 up on the Nadex pound dollar spread. You lost $650 on the pound dollar because you did the spot trade, but since you did the Nadex pound dollar spread, you actually would have resulted in a profit of $760. Make sure to watch our other videos to find out exactly how these box spreads work on Nadex. Also visit us at apexinvesting.com to learn more about how to trade Nadex spreads and binaries.